You've run the numbers 100 times. You save every month. You picture the day you won't need to work anymore. And one number keeps showing up in your research: 4%. Withdraw 4% of your savings every year, and in theory, your money never runs out. But the real story behind that number is far stranger than what you've been told. That number didn't come from nowhere. In the 1990s, an American financial advisor named William Bengen set out to answer a simple question: how much can a retiree withdraw each year without ever hitting zero? He tested decades of market data, crashes, wars, runaway inflation, and he found a threshold that survived almost every worst-case scenario in American history: 4.5%, rounded down to 4%. The rule was born. A few years later, 3 professors at Trinity University picked up the idea and tested it even more rigorously. Their study became famous under a simple name: the Trinity Study. It confirmed roughly the same result. A well-diversified portfolio, withdrawn at 4% a year, survived 30 years of retirement in the vast majority of historical cases. Do you see where this gets interesting? This rule was calculated on the past of American markets, an exceptional past, a country that never lived through hyperinflation, never lost a war on its own soil, never watched its stock market disappear for decades. Other countries weren't so lucky. Japan endured stagnant markets for more than 20 years. Germany and Russia saw their stock exchanges wiped out during the 20th century. If the 4% rule had been tested on those countries, it would have failed, sometimes badly. So why do we keep repeating this number like it's a universal truth? Because the human mind loves simple rules. One statistic, easy to remember, that promises safety. Retirement researcher Wade Pfau has spent years studying this exact phenomenon. He showed that a safe withdrawal rate depends enormously on the moment you retire. 2 people with the same portfolio, the same strategy, but retiring 10 years apart can live through radically different outcomes. This isn't just luck. It's something called sequence of returns risk. If markets crash right at the start of your retirement, before your investments have time to recover, every withdrawal deepens the hole. Even if markets bounce back later, the damage is already done. Think of it like a bathtub being drained while it's being filled. If the water level drops too fast at the start, it becomes almost impossible to catch up, no matter how much it refills afterward. That's exactly what happened to people who retired right before the 2008 crash. Their portfolios dropped 30, sometimes 40%, while they kept withdrawing their usual 4%. Some watched their savings evaporate far faster than expected, not because of a bad calculation, but because of timing. So is the 4% rule a lie? Not exactly. It remains a solid starting point, a useful benchmark for estimating how much to save. But it was never a guarantee. It was an average calculated on one particular past, turned by word of mouth into an absolute certainty. Bengen himself revised his own number over the years, pushing it back up to 4.5%, sometimes higher, depending on the market conditions of the moment. The real lesson isn't in the number. It's in what the number reveals about you. You're searching for a formula that frees you from uncertainty, a magic number that turns a terrifying decision, walking away from a stable paycheck, into a reassuring equation. But money, like life, never moves in a straight line. It moves through crashes, booms, lost years, and miracle years, usually in an order nobody can predict. Some researchers have proposed alternatives: a flexible spending approach, where you cut back slightly in bad years and spend a little more in good ones. Others suggest adjusting the rate based on how the market is valued the day you retire, rather than applying the same fixed percentage regardless of conditions. None of these solutions is as clean as one single number. But that's the point. Retirement was never going to be clean. So the next time you see that number, 4%, stop treating it like a law carved in stone. See it for what it always was: a map drawn from a single territory, later applied to an entire world. You've run the numbers 100 times. But the real question was never how much to withdraw each year. It was whether you were ready to navigate uncertainty, no matter which number you chose.